probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
That was J.P. Morgan Chairman and CEO Jamie Dimon warning about the private credit market in the wake of the First Brands and Tricolor bankruptcies. Dimon making those comments during the company's conference call earlier this week. And joining us right now with more on the potential stress in the system is Marc Pinto. He is Moody's Ratings Global Head of Private Credit. And Marc, a lot of questions about what's happening here, people looking for other cockroaches. What have you seen so far, and what have you found in that search?
Yeah, good morning, Becky. Maybe related to what we just heard, one cockroach does not a trend make, right? So I think what you need to focus on here is the nature of the losses, the materiality of the losses, and whether or not we're seeing a trend.
Yeah, one cockroach does not a trend make, but, where there's one cockroach, there's usually more. I think that's why Jamie said that. In terms of, this may not be hugely systemic. Even these companies that have warned about this have said that, it may not even be material in some of these cases.
Right.
But there are questions that are being raised about, in this credit boom that we've had for this long period of time, have standards relaxed, at least in some places, particularly when you're talking about off-balance sheet issues?
Yeah.
What do you think the answer is?
We have been highlighting, whether it's both in the public markets or the private markets, some loosening of credit standards. We've seen looser covenants in both the bank syndicated loan market as well as the direct lending market. But when we dig deeper here and look to see if there's a turn in the credit cycle, which is effectively what the market seems to be focusing on, we can find no evidence. Now, that's what we're seeing today. That could always change. But if we look at the asset quality numbers that we've seen over the last several quarters, we're seeing very little deterioration at all. In fact, if you look at some of the default statistics that we follow very closely, right now, if you look in the global high yield market, the default rate is a little bit under 5%. 2 months ago, we saw 11 defaults within the portfolio of companies that we rate. Last month, it was only 8. We anticipate that next year, the default rate will go below 3%. So that doesn't indicate to us that there's really a turn, again, in the credit cycle.
Yeah, that's certainly what we've heard from the big banks in their earnings this week. Many of them, not even taking reserves or taking reserves off the table at this point.
Right.
Maybe that's the headline here, is you think the default outlook is going to improve next year, get even better than where we are right now.
I mean, I'm at a conference here in Washington, D.C. this week. It's called the Institute for International Finance. And you have close to 2,000 bankers, asset managers, and insurers talking about what's happening in the globe today. And one of the words that I keep hearing is resilience. I think with respect to GDP growth, we're doing much better than many people thought just 6 months ago. So again, the credit conditions, looking at GDP growth, as well as an expected decline in interest rates, we feel the credit quality is in a pretty good place today and potentially may improve. What we try to do is follow the trend lines, not the headlines.
Marc, when was the last time that you all at Moody's saw things getting worse and kind of warned about it? Like, how frequently does this happen?
Well, I can tell you, it's interesting because when we first started to see some of the dialogue around deregulation, which, by the way, we now call modernization, or is being termed the modernization of the regulatory framework, and we saw some concerns around GDP growth, we did put the U.S. banking system on a negative outlook. So we were somewhat concerned that the conditions were arising, that we could see a deterioration in credit quality. And in fact, that has not come to pass. And in fact, our own GDP forecasts, as well as some others across the market, have been revised upward, and we still see some upward pressure with respect to, again, the GDP growth we're seeing in the United States.
Okay, just in terms of your outlook now, where you expect defaults to fall below 3%,
yes,
put that back in time. Like, what is that reflective of another time?
Yeah, on average, we see default rates somewhere in the 4 to 5% range. In some of the price crises in the past, we've been at 7%. Great financial crisis, we were in double digits in the teens. in terms of default rates. So what we're seeing right now is a very, very benign market. Again, things could change because risk is on the move. You talk a lot about private credit. Risk is moving out of banks into non-banks, out of regulated, highly regulated institutions and markets into less regulated institutions and markets where there's less transparency. And I think that's something that the market has been focusing on. If you can't see it per se, then you may shoot first and ask questions later. So I think that's something that the market is probably focusing on a bit more in the context of what we're seeing on the screen.
That is a good counter view to what we've heard a lot of over the last 24 hours, over the last week. Mark, appreciate your time today.
No, thank you very much for having me.
Again, Marc Pinto is Moody's Ratings Global Head of Private Credit, and it was good talking to you today, Mark.
Thank you.